You say something interesting, Ryan. I want to start here. You say, you know what? The lows of the year could now be in. That's what you're telling your clients, Ryan. How come? Walk me through that. I'm curious, what are the indicators you're watching?
Yeah, thank you for having me, guys. There's so much to talk about here. We'll see if we can get it all out there. You know, when you think about it, we're up like 14% or so off those lows that we hit a couple weeks ago. But just last week, right? I'm sure you had some other guests point some of these things out, but I'm going to go over them again. We had that Zweig Breadth Thrust. What in the world is that? It's how many stocks go up versus down on the NYSE. What we're looking for is a 10-day EMA, super oversold, and then super overbought within a 2-week period. I know that's a mouthful. Just think like this: really oversold to really overbought short term. It triggered last Thursday. Where this matters for the listeners and viewers, S&P's been higher a year later since World War II, 19 out of 19 times. 6 months later, higher, 19 out of 19 times. I mean, that's just one indicator, but that's pretty positive. I'll give you one more, and then we can talk a little more. S&P was up 1.5% 3 days in a row last week. I believe it was Tuesday, Wednesday, Thursday. 1 year after that, it's only happened 10 times. If there were more, I'd share, but only 10 times. 1 year later, higher. 10 times, up well over 20%. There's other stuff we can get into, but I think last week we had multiple buying thrusts that potentially suggest, again, the lows are in, and doesn't mean it's going to be easy. Doesn't mean we're going to go straight up. I want to be very clear there, but the lows of the year are likely in here.
So, Ryan, I know you love to talk technical indicators, but I got to ask a question about the fundamentals too, which is, in order for stocks to not just bump along here, but to actually move meaningfully higher, what would need to happen from a fundamental perspective?
Yeah, I mean, I wish I had a really smart answer, but I think it's as simple as trade. We need to see more concrete news out of trade. We think we're inching closer to that, Julie. I mean, earnings season hasn't been great. You played like I guess a clip of a previous guest right before I came on talking about, listen, the Mag 7's coming up, right? I mean, what do they see in the future here? What are they feeling? I mean, Google did a pretty, or I guess it's called Alphabet now. Alphabet did a pretty good job with what they had to say. What are the rest of them going to say? But at the end of the day, it does come down to trade. Now, one more thing on the economy, and I know I've talked to you guys about this a lot the last few months. When we look at credit spreads, like investment grade corporate spreads and triple B spreads, keep this real simple. What we were seeing, the credit markets were never really worried. I know the market was down in a bear market. I know Mag 7 was down 30-40%. We get all that. But the credit markets have never shown major stress, and that can change in a hurry. I get it. But that's a sign to us that, you can have bear markets without recessions. We pretty much just had one. We've had them before. We'll have them again. And that's, again, why we think the credit markets, smartest guys in the room, we think that's a sign that the rest of this year, stocks are going to bounce back pretty nicely.
And for the economy, Ryan, I'm curious what you see over 2025. Are you in the slowdown camp, the cooling camp? Are you in the odds of recession or rising camp? Walk us through it.
Yeah, I mean, clearly the odds to a recession, Josh, over the last, let's call it 6 weeks, are higher, right? I mean, it started this year, we were probably, say, about 15%, so about 1 out of 6, which is kind of your average year. Now, I mean, next 12 months, we're maybe 30% or so that's not our base case, right? We were overweight equities coming into this year. We've lowered some of that. We're still overweight, but not as much as we were. But the reality, one of the real-time indicators, you mentioned, again, Friday, right? Or a guest before me mentioned Friday, obviously a big day with the monthly jobs number. But one of the positive things that are out there in our view is those weekly initial jobless claims. We haven't seen a spike yet, and it can change. I get it. We were 225,000 initial jobless claims last week, or I guess it would have been 2 weeks ago, announced last week. But the reality is that's still kind of at the bottom of the range. So until we see spikes in initial jobless claims, I'm not saying the economy's great. It's slowing down. We might have a negative print in the first quarter coming up here on Thursday. Honestly, let's just remember, that's old news. Markets only cares about what's forward. It's still something we're going to talk about. We know we have a slowdown here, Josh. One more thing on this. You look at the last 10 years, the first quarter historically is like the worst quarter for GDP. And I don't know if there's quirks in there. I don't know. I'm not an economist. I just know the data. The data says it's normal to get a weak first quarter, and then you kind of bounce back. I mean, I think that's probably what we're going to have again this year.
Ryan, I want to go back to big tech earnings, which, as we've been talking about, we're going to get 4 of the 7 Magnificent 7 this week. And there was a chart from Lori Calvasina this morning, RBC strategist, where she looked at the differential between U.S. X Mag 7, the S&P 500 X Mag 7, and the Mag 7. And that basically, this is something we've been talking a lot about, that the other 493 are expected to start to pick up more of the earnings growth slack as the Mag 7 slow down. Is that still the base case? And is that going to, what happens from a stock performance perspective as this transition's going on?
No, that's a great question there. We think it will continue, right? I mean, you call it, I guess, the 493, if you will, are going to finally come back. We know this time 2 years ago and last year was all about Mag 7. That's where most of the growth and earnings growth were coming from. But it has been, broadening out, I guess is what I want to say. Now with the market acting the way it's been, it's a little different, but we think a broadening out still makes sense. I mean, the time we're doing this, financials are like up on the year. Financials gained 34% last year. That's a really, really important group that's out there, and they've had some pretty solid earnings. So it's nice to see that broadening out from a technical point of view, but also from an economic point of view. Let's put a bow on this, though. We know the Mag 7 matters, right? I mean, they're so influential. We all know that. Every listener knows that. So it's important what they say, but it is nice to see a lot of other companies that are doing pretty good. But the key thing is guidance, and nobody's that comfortable giving significant guidance right now, and that's why the market's murky at best. But again, going forward, let's say the rest of this year, let's see those other 493 play some catch up is going to be a positive, we think.
So Ryan, bottom line, I know you remain overweight equities. I'm curious, when you look overseas, what interests you, if anything?
Oh, absolutely. So when I say overweight equities, people think I just mean like Mag 7 or US. No, I mean, in our unconstrained tactical models that we run, it's a mouthful, I know, but we can do anything we want. We're about 74% equities right now. But when you kind of peel back that onion, Josh, we've got a good deal of European exposure in there. We added some European exposure a couple weeks ago, right? We've got more European exposure than most benchmarks. We have things like low volatility. This is not European, but we have like low volatility and momentum. We got like a barbelled paired trade in there. So we're not just when I was coming on with you guys 2 years ago, we were like 91, 92% equities in some of the models we run. So we've dialed that back. But again, we think there's opportunity specifically in Europe. And one more thing on this. I mean, listen, the time we're doing this, I'm not sure if it officially happened or not, but really close. German DAX is like at an all-time high. I mean, it's really close if it's not there. It's hard for us to think there's this global calamity coming when one of the most important stock markets in the world is flirting with all-time highs. And what Germany announced a few months ago with all the fiscal stimulus coming, those are some reasons we've been dipping our toe into developed international, specifically Europe, in the money that we run for our Carson partners.